Ended up selling everything about 2 years ago. Someone came knocking on the door and wanted to buy everything. They gave us a good deal, so I said, sure. So I'm an enrolled agent. So enrolled agent, our goal is to focus on tax strategies and helping people not pay taxes. I'm a wealth strategist, so before I got into taxes, I had all my securities license. Started out as a financial advisor, but I very much hate what the financial industry does for people. They kind of say, give me your money and we'll manage it. Well, it's not a good way to manage money. So I used to fight professionally, MMA. Now I coach my son's wrestling team. So when was the last time your tax professional asked you if they could help you save save money on taxes? Anybody? So most tax professionals don't do that. They record history. They don't really have the ability to help you reduce your taxes. CPAs, they're accountants, which means accountant, they're looking at all your financial stuff. They're going to do your tax prep work, but they don't actually help you reduce your taxes. But we believe that it's your right to not pay taxes, and the tax code is actually going to agree with us. So the tax code was written by attorneys, business owners, and Congress. So it's actually the majority of the tax code is written to help business owners not pay any taxes. There's 5 factors that cause people to overpay on taxes. First one's going to be choosing not to do tax planning. So most people don't even try to do tax planning. Incorrect business structure. So your business structure is going to dictate what tax strategies are available to you. One of the problems that we see with business structures is mismanagement of the formations. So your LLC or your tax structure may say you're doing things one way, but your legal structure says you're doing things completely different. So what's going to happen is if you ever get audited, the IRS is going to say, hey, you're non-compliant, you're actually practicing this way, and the IRS is going to dictate how they're going to tax you. And then what ends up happening is they're going to open up the door, they're going to go back and look at prior years, and then you're probably going to end up owing back taxes, owing penalties and interest on all of that. Some of the things that we look at that are never taken care of are going to be the minutes, board of directors, operating agreements, articles of formation, articles of incorporations. Incorrect salary is a huge thing for S-Corps. There's actually a very specific way to determine the salary, and it's called an RCR report. And basically, we run a report, and we're looking at prior cases through the IRS, and we're going to look at your area, we're going to look at what you're doing, we're going to look at a whole lot of things to decide what your salary you should be taking. Being disorganized. So I always tell people this is the most important tax strategy there is keeping good books, being organized. I was talking to someone the other day that they got a letter from the IRS going back to 2018. Well, they didn't really have good records. So IRS sent them a letter saying they owed $60,000 for 2018, $120,000 for 2019. They're going to go ahead and look at 2020, 2021. So they're going to end up owing a lot of money, and they don't really have great books, so they have no way out of it. The way the IRS looks at it is if you're not serious about your business enough to have good books, then they aren't serious about trying to help you. Wrong retirement strategies. So coming from the financial industry, all we ever hear is defer taxes, defer taxes, defer taxes. Same thing with your 1031s. All you're doing is deferring taxes, but there's other ways to not pay taxes. One couple of the ways we'll use it for real estate is going to be like if you're flipping properties, maybe doing it in a self-direct Roth, 721 plans, installment sales, structured installment sales, instead of deferring taxes. Something we ran into this year is we had some clients that They came to us for 2021, they didn't pay any taxes, and for 2022, they paid between $200,000 and $300,000 in taxes because they felt like depreciation was going to keep saving them, and they ended up selling some property and recapturing all that, and their tax professional didn't realize that they're going to have that tax problem. Using financial vehicles, again, this is more about retirement planning and using the correct financial vehicles. Choosing the wrong tax professional. So most people use a tax preparer, whereas we're tax strategists. We do work with CPAs because we don't do the accounting side, we don't do the bookkeeping side, but we will work with your CPA if they're a good CPA. So we want to help you avoid missing opportunities. So we have what's called the 3% Club. So basically the 3% Club is for high income earners who don't pay any taxes. So that is our goal, is to help all of our clients get to that point. So how our tax planning works is it's like going to the doctor's office. First, you're going to get a diagnosis, then we're going to prescribe the prescription, and then we're going to fill it. So the first thing is we're going to do an assessment, and we're looking at absolutely everything. We're going to be looking at all your entity structure, last year's taxes, last couple of years. We're going to look at your investments, home auto insurance, all your insurance, and we're going to figure out where you're at today. And then from there, we're going to figure out what's the best strategy, how to get you, how to get your entity better, how to help you pay less in taxes. And then the fill part is helping you get the right paperwork in place. That's something that most folks don't want to do, and most tax professionals don't know anything about. So we have a whole team of advisors. We got financial planners, we have attorneys, we have estate attorneys. I focus mainly on tax planning and infinite banking, or anything to do with life insurance. Life insurance has an incredible amount of uses that most people are not aware of. So our process is to help you generate more cash flow, build untaxable wealth, protect your assets, reduce your taxes, and have more control. So it doesn't really do a lot of good to have a lot of wealth if you're not protecting it. Does anybody in the room have business partners? Okay, so one of the things that we look at with business partners is what happens to you or your business if a business partner leaves the business. And this can be from a death, disability, bankruptcy, retirement. So we've seen business owners get kicked out of their business because they were in a car accident. So they had a temporary disability and they didn't have everything set up correctly. We've seen divorces where a spouse loses part of their business and the other spouse comes in and wipes out the business. We've seen cases where a partner puts up part of the business as collateral, they went bankrupt, and then all of a sudden the bank is their new business partner. So we help people avoid these problems. So here's some of our foundation strategies: entity restructure, your retirement. Has anybody ever heard of an accountable plan? So basically you've got, when you set up as an S Corp, you are now an owner of the company and you're also an employee. Well, an accountable plan basically allows the employee to be reimbursed for certain expenses. So it's tax-free income to the employee, and the business gets it as a write-off. Augusta rule, anybody heard of that? That's kind of a big thing going around. Basically using your business or renting out your house for 14 days a year. Income shifting, so we can shift income between tax brackets, have your kids help in the business, have your parents help in the business. We'll have retired parents help and shift part of that income off of your tax bracket. Real estate's a huge opportunity to pay less in taxes. Medical reimbursements, so your business can actually pay for things like your kids' braces, all your doctor's appointment, all of that. Cost segregation. Who's ever had a cost segregation on a rental property? Most people don't realize that they can actually do that. You can do that yourself. It's kind of risky if you're going to do that yourself, because the IRS has a lot of rules with it, but it can be done on a rental property.
Andrew?
Yes.
Do you guys do cost seg?
No.
Okay.
So here's a couple of our clients. So when we're looking at doing tax planning, we're looking at getting our clients at least a 200% rate of return on their investment. Okay. So here's, over a 2-year time period, we're going to save this guy about $307,000. This other client, we're going to save about $145,000. So he's going to get a 576% return on his investment. Another client, we're getting 418% return. For most of our business owners, it's pretty common to save them 15 to 40 grand a year. I've got clients in retirement that they make 100 grand a year and they don't pay any taxes. And all it is using the correct financial vehicles. So when we're looking at this, we're going to look at your last year's taxes, your bookkeeping, review your current financials, and try to help you from this year moving on. Estate planning, exit planning, succession planning. Who's familiar with exit planning or succession planning? We're going to look at all your current investments, your entity structures, payroll. So my question is, who wants to start saving taxes, or do you want to keep giving your money to the government? You guys are kind of quiet.
Mm-hmm.
I'll keep my money.
I prefer to keep my money. Is there any specific tax questions that anybody has? I just wanted to get through our process real quick, kind of give you a little bit more insight about what we do and how we do things.
So how much of it do you do in-house? So the whole strategy, if I come to you, like cost seg, so would you send that out to a partner?
The cost seg gets out to someone else. I have in-house attorneys that I partner with. They're in Kansas City. I've got another firm. Anybody heard of Mark Culler's group?
I think so.
Okay, so we work with his group for the attorneys. Anything dealing with life insurance, I do all that. I've got another tax group down in Texas that I work with. I've got one financial firm in Kansas City I'll work with, and then I've got another one up in Indiana that I work with.
Okay.
And one of the reasons that I work with out-of-state companies is it's really hard to find anybody in our industry who actually will work together. It doesn't matter if you're in the tax industry or the financial industry, everybody's kind of in their own little box and they want to do what's best for them. Whereas the groups that I work with, they all make plenty of money. They aren't greedy. So they all do what's best for the client.
So they specialize in their niche and...
Correct.
Yeah. Okay.
Yes.
So are you the best place to kind of start, and then you'll help the client determine
Correct.
what needs done and where?
Correct, because I'll run the assessment on everything, and then depending on what you need, it's going to depend on what other advisors work with us.
Would that be a Zoom meetup, or would you rather meet in person?
I do both.
Okay.
Most of my clients that are out of Kansas City, we do Zoom meetups, but I don't mind traveling and getting out sometimes.
Yeah.
Anybody else? What do you want to learn about?
So yeah, these are questions that we get them all the time. Levi and I get them all the time. Like, so it's good to open up the floor to those questions. And would you say like a younger investor? Do you work with more like? I know you're going to say it doesn't matter, but it'd be better to start planning early, right?
So I started up a new program this summer. It wasn't really my intention, but what I noticed is there's a lot of younger investors, they don't know where to start as far as taxes, entity structure, or anything. So we started up a new program for them. And basically what we're doing is we're setting up their entity structures correctly from day one, and then we're looking at infinite banking policies, and then they basically have my tax advice for the next 12 months. It's a pretty good deal for them.
Yeah.
I have a question. You mentioned self-directed,
Mm-hmm.
buying stuff in a self-directed. On that, in talking with companies that are doing the self-directed, I'm an accountant. I really worry about the accounting side of it. Are we supposed to be tracking what's going in and out of the self-directed, or is that company supposed to be providing us? Like,
They
how does that get
should be
reported?
providing that.
Okay.
And your Roth self-directed are going to have a little less rules for the accounting side. I don't recommend using traditional self-directed in any form or fashion because they're going to be a tax trap. I don't recommend 401ks at all to anybody. I don't recommend IRAs at all to anybody. When we're using self-directed, we'll use a combination of self-directed Roth and infinite banking. That way they've got liquidity today and they've got tax-free retirement down the road.
Question, I run a self-directed as well as my own IRA. Can I fund that whole life of that infinite banking? Can I fund that out of that self-directed?
That's a good question. There is somewhere along the lines you can do something with that, but there are some rules related to that.
Okay. But it could be done, you're thinking?
Possibly.
Okay.
I wouldn't recommend it though.
Because of the regulation and...
Yep. I don't like my money being tied up by a government-owned entity.
Right.
One of the things that we've seen with the Secure Act was now an inherited IRA. The person who inherits has to take that money out over a 10-year time period. So then what that, especially if you've got real estate in that, what are they going to do with that real estate? They're probably going to have to liquidate all of it in order to pay those taxes.
Yeah.
So how are you going to pay for your services?
So I got several ways. Tax plan, and typically when I do that, we're going to do a tax plan over your business, your personal, and we're going to do a financial plan as well. Because you can't really do an efficient retirement plan or financial plan without taxes and vice versa. And then I get paid on the life insurance side. I can get paid for AUM as well.
I think a question I have, people that are flipping rather than buying and holding, what are your suggestions there on how to set those up?
Typically, self-directed Roth is one way, but if you're doing 4 or 5 a year, 10 a year, whatever it is, we're going to put some of them in an LLC versus some of them are going to be inside the self-directed. You don't want them all locked up in one place or another. Same thing with your buy and hold. We're going to put them in both because if you put all the buy and holds into a self-directed, you're not going to get the tax benefits right now.
If you put the flips in the self-directed, is that what you said?
Well, with the flips, you don't get depreciation.
Right. Right. Okay.
So we use a combination of financial vehicles. You shouldn't use just one or the other.
Okay.
Any other questions? Yeah.
Your program for new investors, what's it called?
I haven't come up with a name for that.
And then how much does it cost?
Typically it's $1,500 to $2,500. It just kind of depends what you've got going on. That's also going to include getting out of debt plan and getting out of debt much more efficiently and quickly. For example, I got a couple that we're going to get them about 300 grand out of debt on their house, plus another about 30 out of their credit cards in about 8 to 9 years. And as we do that, they're going to build about $150,000 worth of wealth during that time period, tax-free wealth. Because otherwise they would just take all that money, shift it away, and they're going to lose all future value of all that money.
Okay, you said the most important tax strategy is keeping good books.
Yes.
Can you simplify that?
If you don't have good books, I can't help you.
Well, what does it look like to have good books?
Have a good bookkeeper.
Okay, so hire someone?
Yes.
Can I just do it myself, like with
If you
QuickBooks?
want to, but I don't suggest business owners because most of our skills is not in
Absolutely not.
keeping books.
That's,
I don't know how many people, how
That's
many
not
business owners do you see with good books? 0.
Nick, do you keep your own books?
And you're gonna pay a fortune trying to get them right.
Yes.
Do it yourself.
But yeah, we can't help you if you don't have good books. And if the IRS comes knocking and you say, here it is, they're just gonna be like, we ain't looking at this. And they're just gonna, you're not gonna get any of your tax write-offs.
Receipts are important.
Yeah.
Keeping all your settlement statements together is extremely important.
If you can't, the IRS looks at it as you're innocent or you're guilty until proven innocent. And if you can't prove you're innocent, you're guilty.
That is very true.
I don't even do my own books. So, anything else? Yes.
So your infinite banking, and I'm a little familiar with it, except is it like what,
We're going to get to that.
oh, okay. Because I was, is it like the life insurance?
Yes.
Life deal, and you put it in there, and they 4% a year, and
Yep.
then you kind of borrow from it, and
Yep.
pay back, and,
Any other questions?
Not yet.
All right.
It just kicks out. It turns on remote. So you just pull the cord and put it back in.
Is that what it is? It's crazy.
All right. Sounds good. All right. Who's ever heard of infinite banking? Before I start this, what questions does everybody have? Any questions? Any questions?
How quick can you
Access money?
access money? Pull
30
money out?
days.
Bam.
Some companies will allow you to access quicker, but some you have to let it stay in there for 30 days. Any other questions?
So, go ahead.
How do you get it in 5 days or what?
Say what?
How do you get it in 5 days or what?
Because when you need the money, you fill out your name, your number, your policy number, and they send you money.
Sounds like you've got a closing in 5 days. Is that what I'm hearing?
Any other questions?
There is. Can I think of this not only for myself, but so raising capital. So say I'm looking to raise capital. Is this a good way to network with others who might be interested in working with you on setting up a policy, and then one of us manage those funds for them and put it back into real estate?
What do you mean about that?
So is this a good tool for raising capital?
Yes. So when it comes to raising capital, a lot of the hard money lenders that I see,
Right.
they keep it inside a bank account, or they use HELOCs. So the way to think about life insurance is it's a place to keep your liquid capital. So there's only two places that you can keep money that are 100% liquid. One's a bank account, and one's life insurance. And there's a lot of benefits to using life insurance as a place to keep liquid capital. So when we're looking at this, okay. So on a basic level, there's basically 4 financial vehicles you can get money from. Your bank account, loans, retirement accounts, and life insurance. So all we do is we're going to break down the pros and cons of this, and then let you decide what's the best place to get capital. So bank account, they're liquid. Credit cards, they're liquid. Your HELOCs may or may not be, because you've got to qualify for the loans. Your retirement accounts, you can borrow up to 50% or up to 50K. Life insurance, liquid. Tax benefits. You actually get punished if you keep money inside of a bank account. If you happen to earn any interest, they're going to pay taxes on that. Tax benefits from loans aren't taxable. Retirement accounts, if they're in a Roth, they're tax-free. If it's a traditional account, such as 401k, IRA, you're going to get a tax break, but all you're doing is deferring taxes. Who thinks taxes are going to be lower in the future? So what's happening is, one of the biggest complaints that I get from retirees is they pay more taxes now than they did while they were working. Who would believe me if I told you this is one of the lowest tax brackets we've ever had in history? So right now we're in one of the lowest tax brackets ever. Effectively in 2026, taxes are going to go up effectively 10 to 15%. And that's assuming they don't raise taxes back to what they were before 2017. Life insurance, tax benefits, your money grows inside and you never pay taxes on any of that growth. So there's only 2 other financial vehicles that you never pay taxes on the growth, and that's going to be an HSA and a Roth. Has anybody ever talked to you about an HSA? So that's one of our accounts that we use a lot as well. Asset protection. Your bank account provides 0 asset protection. So if you get in a car accident, consider that money inside your bank account probably gone. Inside of a credit card, obviously they can't take money that you don't have. Retirement accounts, they do have better asset protection. They're probably going to be protected in case of a lawsuit. And life insurance has the best protection. In most states, even in a divorce case, they cannot touch your life insurance. They can't touch the cash value inside of your life insurance. Fees, banks have a lot of fees. Credit accounts, you've got compounding fees. Especially if you're using credit cards, they're at 20-30%, which is ridiculous. Retirement accounts, they have compounding fees. So if you got a 1% fee a year over a 30-year time period, that's 30%. Most 401ks have 1.5% to 2% fees on them. So over 30 years, they're taking 60% of your money. Life insurance does have fees, but you get a lot of benefits with those fees. Financial vehicle that's going to give you a rate of return. Your bank account's not going to give you a rate of return. Credit accounts, you're not going to get a rate of return. The financial vehicle itself on your retirement accounts, they don't have a rate of return. Now, the investments inside of them may, but the financial vehicle itself does not. Life insurance, you're going to get a rate of return of typically 3 to 8% a year. If you go back to the 80s, they're paying 11, 12, 13% returns on those policies. And the reason is because interest rates were a lot higher. And now that we're seeing interest rates increasing, what I'm starting to see is life insurance policies are, they're reaching 7% returns on them. And so that's tax-free, so that's like getting a 10% return in a taxable account.
When you sign up for those, are those fixed or are they adjustable?
What do you mean?
So like you signed up for a life insurance plan at 7%, and
So that's the cash value growth inside your policy. So that's going to adjust every year. A lot of it has to do with interest rates. Depends on how you design your policy. Depends if it's in an IUL or a whole life policy. There's a couple different factors to it. Raises. So what we're looking at is your value inside going to increase every year. Obviously, it's not going to increase inside of a bank account. Inside of a credit account, yeah, you may be able to get an increase in your line of credit. If you've done a good job, you pay back, they're probably going to give you an increase. Retirement accounts, it's no increase. Life insurance, it's going to increase in value every single year. So there's guarantees in them. The returns on life insurance, there's guaranteed returns plus dividends. There's no guarantee of dividends, but the companies we use have been paying dividends for 175 to 180 years. So it's a pretty good track record. So borrowing money. So this is one of the areas that most people get confused. They don't understand. So essentially, when you borrow money from a bank, you're borrowing money from the account or from the bank. Credit accounts, you're borrowing money from the credit accounts. From your retirement accounts, you're borrowing money from the accounts. But life insurance, you're borrowing against the policy. So what that means is you're borrowing money from the life insurance company, and the money inside your policy continues to grow, uninterrupted, compounding interest. Now, I mentioned fees earlier for life insurance. So you can also use life insurance for long-term care. You can use it for critical care, such as, let's just say you get cancer, you have a heart attack, stroke. You can basically get an advance on your death benefit without paying taxes on it. So a lot of people, one of the arguments that we always hear is paying cash. So when you pay cash, you're saving up money, then you're spending that money, you're saving up money, then you're spending that money. So as you're paying cash, you never grow any wealth. Now, of course you can go buy assets that are going to give you a return, but that money itself no longer grows. Does that make sense? So one of the examples that I use inside one of my other presentations is, let's just say you make $30,000 a year, or $50,000 a year for 30 years, so that's $1.5 million. But let's just say you earn 5% on all that money, it's about $3.2 million. So by spending cash, you've lost out on all that growth. But of course we got to spend money, but we don't have to give up that growth when we keep it inside life insurance.
What kind of life insurance are you talking about? Is it term life insurance or life insurance?
Whole life.
You use whole life insurance, so this whole life insurance?
Yes.
Yeah, there are different kind of insurance,
Yep.
so.
So life insurance is the only financial vehicle that you can borrow against other than maybe a margin account that is going to continue to grow. But with margin accounts, you've got the risk of losing value, and then you're going to have margin to call if your accounts lose value. So when we talk about infinite banking, or I refer to it as family banking system, you can actually use different financial vehicles. So what does this look like when you borrow money? Let's just say you borrow money. Let's just say you've got 100 grand sitting inside your account. If you're borrowing that money from a bank or from your bank account, you're going to lose that money is going to quit growing. Whereas if you leave it inside of the life insurance, borrow that money, but all 100 grand is going to continue to grow.
So is this the 100K, the premium that you have put in?
Nope. So in this example, this is just $100,000 cash value that's sitting inside the account.
Where's the cash value come from? So let's say I just signed up for life insurance last year. So it doesn't really have a lot of money in there yet.
It might. It depends how much cash you have.
Yeah, but
So I've got clients that start with $3,000 a year. I've got clients that start with $50,000.
so you are talking about they putting a whole chunk of money
Yep.
in that life insurance. It's kind of like a savings account, but in life
Exactly.
insurance.
So life insurance has basically two parts to it. One's the death benefit, and one's PUA, so paid up additions, and the PUA acts like a savings account. So let's just say we design a policy for 10 grand a year. Typically, what we're going to look at is 7,000 to 8,500 is going to go into the PUA side, so the savings account side, and then the rest of it's just going to go to the cost of insurance. And we design our policies that way. That way, your cash is continuing to grow.
This has nothing to do with annuity, right? This is
No. But if you have an annuity, I'll use an annuity to fund these. It's what we do with retirees all the time. So over time, this is what it's going to look like. You're going to borrow money against your policy, but your policy is going to continue to grow. So over time, you just continue. You have one continuous compounding growth.
What's the fee to take the money, to borrow money against
No
life
fee.
insurance?
So life insurance, the cash value inside your policy is yours. Contractually, it is your money. So when you want to borrow money, you just put your name down, your policy number down, how much you want, and they send you that money typically within 3 to 5 days.
Your previous chart, did that show you borrowing against the value before you actually had the value in it? Before you actually had the forward one? It shows you going below basis.
Okay, so this is what happens when you borrow money from a bank or anybody else. So you're paying them back all that interest, and you're never going to grow value. So what happens is you're going to lose all future value of all that money. So same thing when you pay cash, you're going to lose value and all future value of all your cash.
Right.
Whereas when we put it into life insurance, as soon as that money goes into a policy, it starts to grow. And it's going to grow for the rest of your life, so you're never going to lose value from that money.
Can you give an example by number? Let's say just use your example. You put in 100,000, right? You put in 100,000. So and then your money grow, you assume at 5%. And then the next year you take 100 out. So at that time next year you should have 105, right?
Correct.
Because it's already there for 1 year. So you
That's
take it-
assuming you're paying back that 20,000.
1,000.
That 20,000 that you borrowed.
100,000. I'm
She's
talking
borrowing the whole
about
100,000.
100,000.
Oh, the next year?
Yeah, next year. Let's say this year, I put in 100,000 in there, and the growth is 5%.
Mm-hmm.
So at the, next year at this time, you will have 105. This is 5%.
Correct.
So and then I take it out 100,000. So this is zero there right now, right? Or maybe 5.
Your money stays inside the policy growing.
But I want to borrow it.
So you borrow money from the life insurance company, and your money stays inside the policy growing.
So my money is still there. The insurance company will write me a check for 100,000.
Correct.
Okay, and then do I need to return the money to them?
Technically, you don't have to repay the loans,
Okay,
but it's your own banking system, so you should always be paying back your money. And then the other part of that is when you get paid, your money has to go somewhere. And so for most folks, they put it inside of a bank account, and it's doing absolutely nothing for them. So let's just say you've got rental property, so instead of putting that rent back into a bank account, you're putting all that rent back into the policy. Or let's just say you're flipping a property, you're putting that money back into the policy instead of letting it sit inside of a bank account.
So maybe you said this, I had it this, I'm sorry if I did. So is there any interest being charged to you by?
Correct, yes.
Okay,
Um,
so is that always gonna be less than whatever, the 5%, let's just say hypothetically that it is, that the interest that you're earning on your money versus how much you're borrowing, what your interest is that you're paying?
So the interest from the policy is simple interest, whereas your money inside the policy continues to compound. So you create positive arbitrage, and essentially the cost of the insurance is going to be less than the growth. Now I borrowed against my IUL last year. I took 23 grand against it, and because my money kept growing, that whole 23,000 cost me $400 for the year for interest. Now next year, because I'm managing my IUL a little bit better, I will actually have a positive amount in that. Because my interest rate on my IUL is only 2.9%, and my growth inside of it is 5.5.
How much of your policy can you loan? So like, if you had a $2 million life insurance policy, could you loan $2 million?
If you had that much cash value in it, you could take
Oh, so
out
you can only loan the cash value that's in it?
90% of the cash value.
Oh, okay, okay.
Yes.
You're paying a monthly fee for the premium for the policy, though.
What do you mean by that?
Well, if I take out $100,000 whole life policy, I'm gonna be paying a payment every month for that. Let's say it's $80 a month. So I'm gonna be paying $80 a month into that policy to get that $100,000 policy.
Yes, you do have a cost of insurance. Because this is life insurance, so there is a cost of insurance.
And if it gets to a certain point, they freeze it. That's what happened to me.
What do you mean they freeze it?
Well, I was putting in X amount of dollars into the policy, and they said that I had paid too much in, so now I'm not paying anything in.
Yes. So basically there's called a MEC rule. So what that means is the amount of money you can put in is based on the amount of the death benefit. So what you're not allowed to do is put so much in that a life insurance policy turns into an investment vehicle. Because what they used to do is they would have the wealthy just put hundreds of thousands or millions of dollars into these accounts, and they'd be growing at 12, 14%, and they would never have to pay taxes on it. So this is one of the few rules changes that there's been to life insurance.
My question on that is they've never notified me when I need to start paying back in again.
You should probably get a hold of them.
If you don't pay, you lose a little bit.
No, so your growth, we have what's called a break-even point. So 5 to 7 years, basically the amount of money that you pay towards the policy equals the cash value. And what ends up happening is after that point, it's going to generate enough income inside that policy to pay for the cost of the insurance.
So the insurance money doesn't go into, it doesn't become equity in your policy, correct?
What do you mean?
Like the monthly payment that you make to the insurance company, it doesn't add cash value to your policy, does it?
Let me see if I can.
Are the ones that you are using, do they have age cutoff?
What do you mean by that?
Well, I think mine goes up to 90 years old.
So you can design a policy to be a 5-pay, 3-pay, 65. You can design a policy to stop whenever you want it to, at whatever age you want it to.
you cash it out?
Yes, but you may have tax consequences. But if you want to borrow, so here's how we do this with retirees. You just borrow against the policy, and then the cash value continues to grow. So what will end up happening is, if I can find this one,
So you can't just keep putting money in there as a retirement and then decide to retire and pull that money out of there without there being tax penalties for that.
you can pull up to the amount you put in, and then basically from there on out, we borrow against the policy.
That keeps you out of the taxation, right?
Correct.
Yeah. You just
So
borrow.
For your, and your children, like you do pass on, do they get this full amount, are they taxed on that money that you put in there that's accumulated?
It is a tax-free death benefit.
Okay, I have a question.
Unplug it again. Oh, there you go. Boom.
So here's an example. I don't know if you can see it very well, but we're showing putting in $7,700 a year for 25 years, and that grows to $393,000. And then from here, you start borrowing against the policy, and you're going to end up getting close to $590,000 out of this total in retirement.
How much insurance does this person have? Is it 1 million?
We started out at 1 million, and then we end up at 1.1. But you can design these policies 100 different ways. I've got a policy that is designed for a lot of cash value up front. I've got a policy that is designed for a lot of income in retirement.
So let's say if this person have $1 million insurance, so when I die, I have $1 million insurance. When I die, my kids will get that $1 million insurance, right?
Correct.
And then now, I already have $100,000 cash value in it. And I can borrow up to,
90,000. So let's just say you take,
95%, right?
yeah, so you,
5%, so 95,000, is that right? I can borrow up to 95,000 because it's 95%.
90,000, so about
90,
90%.
Okay, so that's 90%. So I borrowed 90%, but I have $1 million insurance. So when I pass away, because I borrowed that 90,000, so if say I die, my kids will get 992.
910,000.
Yeah, 910,000.
So
right?
when you borrow against the policy, let's just say you take 90,000,
Yeah.
they use your death benefit as collateral. So typically you borrow money from the bank or somewhere else. Maybe they're going to use your house as collateral, maybe your car, whatever. Life insurance company uses your death benefit.
So they will deduct that amount
Correct.
and then give the remaining to your
Correct.
family.
Yes.
So if I had a $1 million life insurance policy and I put like 900 grand in it, whenever I die, do my kids get $1.9 million since I've put in 900 additional on top of the monthly insurance?
So your cash value can never be higher than your death benefit. As you put more cash in, your death benefit continues to grow.
So like your 1 million policy would probably go up.
Okay.
Yeah.
So this insurance will be 1.9 million because
Maybe. Don't get too hung up on all the numbers and the amount of death benefit and cash value. It's more about the process. Because we can design these policies to fit your needs.
I've got a question.
Go ahead.
Okay, yeah, I got a couple things. One When you mentioned the term IUL, I wasn't sure what IUL was.
So index universal life policies, so the difference between whole life and IULs is whole lives have guarantees and they pay a dividend. IULs, the returns are based on the stock index.
As a guarantee something?
No. However, some IULs do offer a fixed account, so I figured the stock market was going to go to shit this year, so I put all mine inside of a fixed account, so I'm getting 5.5% on my IUL.
You made a comment when you first started this that the life insurance that you were talking about can pay for like 170 years. Is that what you said? That's what I thought you said. So I was thinking, does this become like an inheritance thing and it keeps growing for whoever inherits it?
Mm-mm.
Companies that you've been using.
Yeah, the companies that we use have been paying a dividend for 150 to
Okay,
170
that's
years.
Yeah, I just pictured it as different.
So there's only certain companies to use for this strategy, and there's only certain advisors that should ever even talk about this, because most advisors don't understand how life insurance actually works. Not to go off too far, but when it comes to business owners, we can use them for retirement plans, we can use them for profit sharing, 162 bonus plans, 412 plans, which basically if you're a high income earner, you can defer up to 6 figures with these. I think this year it's 245 grand. You can put into a life insurance policy and defer those taxes, and then basically in 7 years you pay all those taxes and you let it grow tax-free for the rest of your life until retirement.
So utilizing one of these as, say, a new investor that had $100,000. Because the way I'm kind of understanding this is like it's a secured bank account where I get the loan for my own money. But then I have a mortgage or I'll have a payment on my own money. So would you say I would be able to grow faster, or would the growth be a little bit slower, since I'm going to also have to be paying back that down payment that normally I would have already paid and wouldn't have to pay on?
You don't just put in $100,000, right? I mean, you only pay in premiums,
Paying
correct?
You can. I've got clients, they put in that much a year. I've got other clients that put in $3,000 a year.
But that's a year. That's not just like I'm going to put in one big chunk.
No.
And then I only want to put in so much a month.
So we can design it. So I've got another client, retiree, he inherited a bunch of money. We put in $85,000, and then after that, his yearly amount that he puts in is about 22. Because he had that big chunk of cash sitting there. So that's how we designed this policy.
What was his death benefit?
I think on that it's like 450 or 500.
Was it? Yeah. Of course, age. I mean, all the factors, but
because we weren't concerned about death benefit.
right.
The way it worked out is it started out as well over $1 million, and then it tapered down. So in order to put that much cash in there up front, we had to increase the death benefit.
Yeah.
But to answer your question, so I've got another presentation, and I'll send everybody my videos, but showing taking $100,000 from paying for a house from a bank account versus from a life insurance policy. After a 30-year time period, the complete wealth is almost 3 times as much by borrowing from the life insurance policy.
I was talking more so like from an investor side. So like if I was starting out investing, I've got $100,000 cash. How would the benefit look like for me putting that $100,000 in here and start taking my loans from that versus just taking my $100,000 and going buying, so let's just for easy math say I have to put 10% down, I buy 10 $100,000 houses. That's what I was kind of saying, like the growth on it. Like, does that slow your growth because you are gaining the 100,000 at 5 to 8%, but you can only access so much? But then I've also got payments against my cash now.
So instead of making payments back to the bank, you're going to put your payments back into the policy. So that's going to accelerate your growth. Now, over the first 2 years, you're gonna have a little less cash, but long-term, about 7 years down the road, 5 years down the road, you're gonna have more wealth. So it does accelerate your wealth. Has anybody ever heard of BOLI? So if you keep money inside the bank's keeping it inside life insurance. So what the bank's doing is they're borrowing that money from the life insurance, and then they're lending it to you for a premium. So we're cutting out the middleman.
Are these rated for health just like any other life insurance policy?
Yep. But because you're looking at the cash value growth instead of the death benefit, they're not nearly as affected. Because you don't have as much of that money going towards the cost of insurance. So at the end of the day, it doesn't really make a huge bit of difference.
Do pre-existing conditions or any other sort of things affect your eligibility to create a plan like this? Because it's
Yes.
life insurance?
But again, it just depends what you've got going on, how you're taking care of it. You know, I have some.
Does it matter longevity in so if you start when you're really young, do you get breaks over time?
What do you mean by that?
If you've been in it for 10 or 15 years or whatever.
Mm-mm. I mean, the cost of insurance is less expensive. So the younger you get in, the better off and the more wealth you're going to grow. So this is how the Rockefellers and all those wealthy families keep their wealth, is they've got a family trust. So every person born in the family gets a life insurance policy, and they use that as a line of credit. And then when they pass away, that money goes back into the family trust. And somebody in the family needs to borrow money, they borrow money from the trust. It's something that the wealthy have been doing for the last 200 years, but they don't teach it to us. Any more questions? Thoughts, comments?
Confusing.
What's confusing about it? So I'm going to break this down in the most simplest form. You've got two places to hold your money. Or you got different financial vehicles you can hold your money in. So what we're looking at is what happens to your money inside of those financial vehicles. And then we break that down even more. There's only two financial vehicles you can hold liquid capital in, either a bank account or life insurance. And then we're looking at what does each financial vehicle do to your money while sitting inside those accounts.
Seems simple.
It is super simple. But because the way we've been trained to think about money and investments, it makes it more confusing.
Are these contributions tax deductible at all?
Nope.
Okay.
So you can't write the contributions off on your tax bill?
$10,000 a year or whatever, probably not.
No. But you can grow more untaxable wealth inside these accounts than you
Right.
can any other account.
Makes sense.
Unless you own a big company and you sell it and your Roth owns all the shares of that company.
So let's say, if say I have $100,000 and I have $1 million insurance, and I have that cash and I put it in my insurance, right? Still going back there because I didn't get it. So I still want to use that $100,000 invest in the properties.
Mm-hmm.
So can I use that 100? I can borrow up to 90,000 out, right?
Mm-hmm.
So let's say I can buy maybe, let's say use it for down payment for street properties. How that work from there?
You just tell the insurance company you want the money, they send it to you.
And then from there, you will just like
Buy those properties.
buy the property in for the, all the tax advantages and the depreciation and all this, everything's the same?
Yep.
I think her and I had similar questions, kind of separated, but she's gonna borrow her 90, and then she's going to have a payment to pay her insurance policy back the 90.
Correct.
Yes. So that's the advantage you get.
So I will have a
Advantage,
payment to
disadvantage.
pay it back.
You get the money, but
You have a payment
still
on it
gonna
now
pay the
versus if I
payment, but you're
spend it.
making money still.
Yeah,
off the
it's
money
like
that
You're
you
paying
made.
your, it's like
Yeah.
you're gonna be your own bank.
Yeah.
Yeah.
So-
it's like
So
you
you're
got a
getting
loan
paid,
for
you're getting rent income from those properties, right?
Sure.
So instead of putting it back into someone else's banking system, you put it back into your own banking system.
But I would have to be getting a rent higher than normal because I'm gonna have 10% more payment. Is kind of what I was looking at. Like normally, if I go right now and I take 10 grand and put it down on a property, and it's a $100,000 property, my loan's only gonna be for 90. If I take it out of this, I'm gonna have a loan for 100, 90 from the bank and 10 from my insurance.
Correct.
So I would have to do my numbers differently to make sure that I ROI to pay back both of those amounts. That's kind of what I was getting at.
Or you don't have to pay back that 10 grand. And then that policy is going to continue to grow over the next year. So let's just say it grew 5 grand. So take that 5 grand and pay back that loan then.
But the benefit would be is that I have, instead of that $100,000 being gone and me having just the 10 properties, I'm still growing off of the 100. I
Correct.
have the 10 properties. I just had to pay it on the extras. Okay.
Correct.
The payments can be set up any way you want them, right?
Correct.
Structured, amortization, all that? Okay.
You dictate the payment, not the bank.
Yeah.
Like I didn't pay my 23 grand back until I paid part of it back this year, and then I just kept the rest of it going. I paid the interest and I didn't pay back all the loan. I'll pay it back sometime in the next 6 months. But since I don't have to pay it back, I'm using my money to grow my business.
Is the interest comparable to what you would be with a bank though, as far as?
So right now, my Penn Mutual policy is 5.5%. My Allianz is 2.9.
So you can just pay interest only and you never have to pay back that principal until you die?
Correct.
Then it wouldn't grow very fast, right?
As long as you pay the interest payment, it will be okay.
Is the interest always 2.99%?
No, it fluctuates. Part of their interest is determined by the Fed.
But you said it's simple interest based upon your loan amount. So if you loan 20, you're paying simple interest on 20. Your account's still growing at the 5 to 8 on the 100.
Correct. Because all loans are simple interest.
Sure. But so you'd be compounding more.
Correct.
You'd be paying, so you're still making more money. Okay.
So the way I look at it is even when I borrow money, I'm still making money. I make a profit most of the time when I borrow money.
And so this isn't like a 401k or anything where whatever you invest in, where it stays within that. This is basically just if you got a loan from a bank, so all of the strategies are normal and you just pay yourself back. There's no restrictions as to, that money has to go anywhere else.
Correct. It's your money. You decide what you do with it.
So once had a guy talk to me. He was wanting to premium finance the premium, right? So go get a premium finance company, load the policy. What would be a benefit in that? Like, where's the
So
benefit
what we'll
there?
do for retirees is we'll do a quasi premium financing. So they basically make the first 2 or the first 3 payments on the policy. They don't make any more payments on the policy.
Okay.
It's gotten a little more difficult as interest rates have gotten higher, but there's some different ways we can use it. Like we were using a bank to fund the policies at a 3% rate.
Right.
So our clients weren't having to pay the insurance policy.
So you were financing the funding of the
Correct.
policy.
The bank basically pays for the funding, or pays for the premium.
So what's backing that loan? So what's the collateral for that loan?
Death benefit.
Yeah, you can stack them, right? So, I mean, you can get a death benefit as the collateral on like a line of credit too.
And that's pretty easy to do.
Yep. So actually, if you use your death benefit from a life insurance company, banks will they'll charge you less interest because of how safe that
It's almost guaranteed, right?
Yep.
So they know you're gonna get their money, so you can pull like a big line of credit by using that death benefit as your collateral.
So back during the
So then you're double stacking, so then you'll have cash value you can borrow against, right?
Yep.
And then you still have you got the line of credit you can borrow against, so you're stacking investments.
So back during the 29 crash, when all the banks crashed, all the life insurance companies had the money, and that's where everybody got their money from.
So, okay.
Because they are the safest financial vehicle on the planet.
So I wonder what our true cost of interest would be right now to do that. Like, just wonder what it would cost me to do that.
What do you mean, true cost?
So I'm paying interest to the bank for whatever my loan is, whatever. And it's growing at what, 3 to 5 here?
Yeah, so let's just say you're borrowing from the company, let's just say for simple math at 6, but your policy's growing at 5.
Yep. So it's costing me 1%.
But because it's simple interest versus growing at compounding, the net effect is
True.
you actually
You're
grow
only
profit.
gonna get 1% for a short time, and it's gonna overtake.
So why don't more people do that?
People aren't educated. The wealthy do it.
doing this?
I can go and talk to 20 wealthy people and probably.
I don't have a lot of capital guaranteed put into it, so
You're saying that you're financing the premium, right?
I haven't ever looked into that.
Okay.
I can probably go, Chris. I can probably go talk to 20 wealthy people. 15 of them are doing it.
Doing what we were just
Infinite
talking about?
banking.
So I've got a client that I know has a LERP. Is that the same as this? Or different?
A LERP is more set up for retirement planning, but just because it's a LERP doesn't mean it's any good. Because there's only
So
certain.
they're putting a significant amount of money in.
Say what?
They're putting a significant amount of money in.
It's all about how they design the policy. Now the problem is with LERPs, most of those are IULs, and IULs pay very, very well. And most advisors who work with IULs have no clue on how to build them. Like I see all the time on Facebook or TikTok to use IUL for infinite banking. I would never use an IUL for infinite banking. Now I borrowed against mine because I understand how they work, but I would never have a client use it for infinite banking. And the life insurance companies will tell you not to borrow against an IUL for the first 7 to 10 years.
Can you convert policies over?
1035?
Like, could you take a LERP and convert it to a different life insurance policy?
No.
So you're there, what's there is there. Okay.
But you can take the growth inside of a policy and then go buy another policy.
Okay.
Then you got 2 policies growing.
Now we're talking.
How quickly can you pull your money out if you start the policy?
30 days.
When you very first started it?
Yep.
30 days.
So, okay, so if you've got, let's say you got a tax problem, you know you're gonna have coming this year.
You have what?
Let's say you have a tax problem, you know you've got coming, you know you're gonna have a sum of money. You wanna put some into this, so you could help strategize on what do we do to help avoid, you know,
So we'll
what do we do to fix this tax problem before the year finishes? Plus, how do we do it?
So we'll put a lot of money into one of these if they got a tax problem, and then let it sit there and start to grow, and then take the money out and pay for their tax problem. Same thing if you've got a lot of debt, we'll use these to help accelerate debt and grow wealth at the same time.
Does this have to be a specific kind of life insurance?
Yes. Has to be designed for high cash value.
So this is, we can't necessarily do it in banking if you're like a state employee and they pay your life insurance.
No. So that's term insurance, and that's never enough life insurance anyways. Because with a policy from work, it's gonna be like 50 or 100 grand.
Just covering their accident.
And 50 or 100 grand is not money anymore.
So you said that the first 7 to 10 years, we can borrow money against our policy, is that right?
Against an IUL, different type of life insurance policy.
So if we get a life insurance policy from, say, you, like I bought one from you, if I needed to borrow money against it, this is pretty complicated, everybody here can attest to that, but if I did need to borrow money against it, could I just call you and say, I need 10 grand against my life insurance
Yes,
policy?
I'm gonna make sure, and I'm gonna write up a contract with you to say how you're gonna pay it back.
Question.
And if you don't pay it back, that's on you. I've written this out, you know exactly.
Well, I'm glad you set us up for success.
Question. Can I be the owner of his policy?
No. You have to have an insurable interest. Now,
But business partner, right?
business partner, insurable
Boom.
interest, kids, parents, grandparents. So one of the guys that, he just passed away, but he had cancer and couldn't get life insurance. So he had a policy on all of his kids, all his grandkids. He had over $10 million in cash value, and he used it and lent it out to business owners. So that was how he made a lot of tax-free wealth.
So you can buy life insurance for other people as long as you have an insurable interest in them?
I wanted to throw that out as a question, but yeah. So, yes. Keep
Now,
people-
if he's your business partner, then you have an insurable interest.
and my cost of insurance is cheaper, right?
Well, then you, depending on how it's set up, your business may be able to get a tax write-off
Yep.
for it.
Oh, so you can deduct it if it's not for your personal life
If
insurance.
it's business, there are possibilities.
But if.
So my
if you
child is
deduct
an
it,
employee?
it's not the benefit you
I like the way you think.
you're
If it's
deducting
set
it.
up incorrectly, yes. So it has to go back to the business. It cannot go to the individual.
Yes.
So my child is an employee, I can write off $12,000, whatever, a year, as long as they're justly paid and doing work adequately, you know? You know, that's
It's
a
like
thing.
13.8.
Yeah.
It's like 13.
So my child is an employee. I use them as models for a website.
Yeah, don't do
And
that.
well, all right, whatever.
The IRS is
or,
going to nail you for that.
or maybe
Contrary to what they say, your kid should be at least 7 years old. If not, good luck with the IRS.
all right. Well, then, what if they're a line cook at a family business, and I pay them $13,000, but now they have an insurable interest as an employee. Now, will their life insurance also be tax deductible?
If it's set up correctly and it's set up to go back to the business, not to you as a parent.
Oh, okay.
That's fine.
Your kids can shred a lot of paper.
Which you-
There's
Yeah.
there's a lot of.
Give them some scissors.
We have a lot of talks. There's a lot to do.
Oh my goodness.
So if you have an employee, there's what's called a 162 bonus plan, which instead of using 401ks, we use life insurance as a retirement plan. And let's just say it's 10 grand, then that's going to be considered income towards them. So the bonus part of that is you as an employer, you pay the taxes on that.
No.
And you as the employer have access to that cash value while they still work for you.
Oh.
So if you have money, keep it inside life insurance
Again, or
instead of a bank.
to fund it or against it?
Using it as collateral.
Okay.
Any other questions?
How many open
that's what
appointments
I'm
do you have
interested in.
between now and the end?
Even if it costs me just a bit.
You know what? I forgot my business.
That's
I know. I thought about that at lunch today. I was like,
Specific policy, just
Oh,
so
well.
you could get that line.
Yeah.
so that means I need to
That's
get everybody's business cards. And everybody will get sent my videos. So I've created a video series on retirement planning, why we don't use IRAs or 401ks, video series on IULs, and a video series for infinite banking. And then I'm going to start doing a lot of tax videos.
So you wouldn't even recommend using this sort of thing in tandem with a 401k or an IRA?
No,
You-
401ks are a terrible financial vehicle.
They are.
What about an IRA though?
As self-directed, it's okay.
Okay.
But it has to be
Control.
used. You have to control it. And a financial advisor will always tell you they're a bad idea because they don't get paid for it.
But you don't really recommend converting a self-directed IRA or a 401k to,
We do it all the time. So I had a client, they make about 400 grand a year. So they're in the highest tax bracket. They had about 950 inside an old 401k and an IRA. So over last year and this year, we're cashing it out. They're only 55, so they're paying the 10% penalty. They're paying the highest rate of taxes on them. And we're going to turn that 950 into about 2.5 million guaranteed tax-free.
but then they'll have to pay taxes on all of it took out, put into this, right?
Yeah, after paying the taxes, after paying the penalty, they're going to have about 2.5 million tax-free.
But they had less than that when you put it in, right?
Yeah, they only had
Over
950.
10 years.
How'd you do that?
That's what life insurance does. Compounding growth.
But he just put it in, so there's a hard way anytime to come back.
Well, that's by the time they retire,
Oh, I see.
because they're only 55.
I see.
So we expecting them to start taking it out about 68. So they'll get about 2.5 million or so tax-free. And had they kept it in there, they would have already been losing money.
Can we use the transfer money from the 401k to self-directed IRA, and then from there, use it to pay, put it in the cash value in insurance?
If you have an old 401k, then yes, it can be rolled over into a self-directed. Well, not exactly, but it can be done. And then typically maybe we'll cash it out. Or maybe we just cash out the 401k.
But if you cash it out 401k, you have to pay the penalty though, right? If you're not 59.5.
Yeah, there's a couple different ways we'll do it, but don't worry about the penalty. We'll make up that money.
And put it in the cash value insurance?
Mm-hmm. Most of our retirees, that's what we do with a good portion of their money, is use it either IULs or whole life for retirement. And that way their money's safe. They don't have a tax problem, and it's going to continuously grow.
So just to be clear. So if you borrow money against the, say you had $1 million of cash value or whatever in the account, and you borrowed $900,000. So what would happen if you took that? Can you take that $900,000 and add $900,000 more cash value in your account, and then
Just buy another one.
just pay back the loan?
Buy another
But
one.
still keep
Buy another one.
another policy? That's a good idea.
I'm about to buy my third one in less than 3 years.
Where are we capped at as far as life insurance to earnings? Is there a cap?
Sort of.
They're supposed to be,
You
but
gotta make a reasonable,
Yeah, and
you can make a financial statement look real good.
yes.
Yes.
it's like a 20-to-1 ratio.
That's
So
I
if
was
you make-
I was saying 15, but
If you make
yeah.
$100 grand a year,
I'll
you
go
can get a $2 million policy like that.
yeah.
It's not difficult.
This is gross, right?
Yeah,
We can go off gross.
yeah.
Oh, I thought you were talking
Projected
about the
growth.
numbers were
Projected.
gross.
Yeah.
There's,
Oh wait, I'm gonna be a millionaire within this year, so that's my projected income.
yeah, they'll do a
I might-
financial check on
I
it.
might just fall a little short this year.
But
But trust me,
as an agent, I'm not gonna let you do that, because if you can't make that premium,
Right.
I'm gonna be pissed off.
Right.
Because I don't wanna see my clients fail. Because that makes me look bad as an advisor. So typically what I will do is I will be more conservative on your first policy, because I don't know if you're gonna, especially for business owners, I don't know if you're gonna be able to make that deposit every single year. And so maybe by year 3, you get another policy.
Yeah.
But I would rather be conservative than just say, hey, you think you can do that, and then by year 3, you can't put all that money, and then it's not good for me or for the policy.
all joking aside, so if you have a lot of cash to throw into a cash value insurance policy, then I could see the benefit there. If you don't have a whole lot of cash immediately to throw into it, do you see a benefit in starting it, or would you rather use that money to invest in actually getting the funds and then dropping the 100,000, whatever?
The sooner you start, the better.
Even if it's like you're not going to be able to use that cash value immediately, because like if I can start only with like $3,000 a year.
That's fine.
Okay.
That would be plenty. We would basically design it so 2,000, 2,200 would go to the cash value. And how old are you?
23.
Like 10 years down the road though, that 5 to 8% or whatever, you know what I'm saying? Like that money's gonna be way bigger sitting there.
So 10 years down the road, you put in $2,000, your policy's probably growing by 6 or 8 every single year.
Gotcha.
So I got one of my illustrations where, 20 years down the road, they put in $100,000, but their policy grows by $345,000 because of that compounding growth.
Gotcha.
Lots of questions.
More the better. I want everyone to understand how these work.
Well,
What do you get to choose and what can you not choose? Like, can you choose how soon you take it out? Like, what are options
terms?
and what's not options?
Terms of loan paybacks. So think of it more as a line of credit. So let's just say you take $50,000 as a line of credit against a house, and you start paying that back. You may not have immediate access to that cash. You may actually have to reapply for a loan. Whereas life insurance, you start paying that back, you have immediate access to that capital.
And is it fixed rate interest? Because it's whatever you decide.
It changes on the anniversary date every year.
So like if I do the loan, because you were talking about how I set up the contract and then I'm going to pay myself X amount and you create the terms in the contract that you were going to hold him accountable to, right? And so
That's what I do as an advisor for my new clients.
Yes. So, but you can control the terms. So, can you set the interest rate higher or lower, or
Yep.
so like I can pay myself 1% interest, or
So technically,
10% interest, or
Yep.
it can be anything.
Yep. So the way we look at it is you always hear advisors talk about pay yourself interest. Where that comes from is if your policy is only charging you 5% to borrow the money, but you're willing to pay a bank 8%, you should be paying back your policy that 8%, not just 5% that it's charging.
So you can pay even more.
Yep. Terms of the loans, you dictate when you pay them back.
Okay, so each time that you do it, it's gonna be a whole paperwork thing.
Yep.
A whole process. It's not a whole process, it's just a,
Say that again.
if there's not like a whole process per loan, it's just.
No,
a
it is.
withdrawal?
You don't have to show paperwork. You don't have to show debt. So your debt to income doesn't matter. Your loan to value doesn't matter. Nothing matters. It is your money.
And you can do up to 90% of the cash value.
85 to 90%, depending on what company.
So if you,
Can you deduct the interest that
Yep.
you're paying back your
Yep.
insurance?
Yep.
So would it be almost beneficial?
So if you design your own interest rate, can you pay a much higher interest rate than conduct that business?
Yep. So if you're a business owner, what we're gonna do is create a promissory note, and then you're gonna use that. Now, the IRS does have guidelines on that, but, I mean, they're fairly flexible guidelines. And that's gonna end up giving you a tax break, basically.
So the only way to increase your cash value that you could borrow against is to put the money in it. Because, I mean, just buying the cost of insurance doesn't get you anywhere. You need to use it as a bank.
No, you don't have to use it as a bank, that's just how we utilize it.
But that's how you get it to go somewhere. And you just pay the cost of insurance, it doesn't go anywhere.
What do you mean? The cost of insurance stays the same.
You're gonna get 5% on the cash value anyway, right? So.
Right.
So right now, I'm designing policies.
It'll go up.
Yeah, your
all
cash
that
value is
stuff.
gonna increase,
Never gonna.
your death benefit's gonna increase.
And what is the investments, like the 5 to 8% and the actual cash value? Is that just in the stock market? How is that grown? Because you said don't give your money to people, just invest it. So you want the control. Is that
So life
eventually?
insurance companies own everything. They own sports teams. I've got a client who has partnered with a life insurance company, and they go out and buy multi-unit real estate. They own sports teams, stadiums. If you ever seen in the mail or you ever see these, hey, borrow money and 20% or whatever, well, there's a good chance that life insurance owns that block of money. Most of your money in the banks is actually in life insurance. So the top 5 banks alone have over $75 billion sitting in life insurance. And then they use that money to pay, they use those returns to pay for employee benefits, executive retirement plans, stuff like that.
So you said that you have 3 life insurance policies?
I'm about to get my 3rd one.
So like, what does it take to get more than one? Like,
You max out your other ones?
oh, okay. So that's the only way you can get another one is if you max out the first one.
Well, you want to max that out for maximum efficiency.
I see.
How do you max it out? How much? Like, no, I don't know. So what does it mean max out? Because normally you just pay the premium, right? For your insurance.
It means I can't put any more money into my policies right now.
Kind of like what he said earlier, is he got capped because his policy was set up to where his premiums he can't pay anymore.
Yep.
You similarly
So I just
cannot
buy a
pay
new
anymore.
one.
Cap is how much? Like,
Depends how you set it up. Like mine, one's like close to 30, one's close to 70.
70,000?
Yeah.
So it's the face value of insurance is like 1 million?
I think both of them are sitting around $500,000.
Oh, okay.
Because most of my money is in the cash value, it's not in the cost of insurance.
I'm even more confused now.
The higher your death.
The higher your death
That's
benefit is, the more cash
The more you can kind of pay into it,
you.
right?
Don't get too caught up on this side of things, because this is
Yeah.
something down the road. When you decide you want a policy and decide what you want it used for.
In relation to a insurance, you can only, the maximum you can put in cash value is 70,000. That's not really a lot.
All that's gonna depend on a lot of other personal factors, right?
Yeah.
Couldn't you just raise the other side, so you could keep putting, have more cash value and raise the other side? Like the debt. Cause it's all written in the beginning.
Correct.
Okay.
So kind of, if you look at this one, it's $1 million, and it just kind of slowly grows, and that's because of this was designed for maximum cash value. So even over 25 years, cash value,
Made 183,000,
yeah,
but the cash value's high,
yeah, cash value is 393.
90% of that.
So. And then, like you'll see on here, it shows pre-tax return 7.5, 762, 773. So that's the pre-tax returns. So those policies are getting 7%. And so what I did with this policy is I compared it to the S&P 500 during the same time period, and it smoked the S&P 500.
Everybody like 4 or 5%.
And if you go back even before this, you're almost always going to see whole life beat the S&P 500. But not comparing it to the stock market. I'm just stating a fact. Because life insurance gets a bad rap about the rate of return. And
Because they want us to put our money in the stock
yes.
market.
And where do they put their money? So COLI, corporate-owned life insurance, they've got hundreds of billions of dollars sitting in life insurance. So you're giving them money, they're sticking it in life insurance. That's why they always grow and never pay taxes. That's one reason. Anything else? Done?
That was good.
Thanks.
Yeah. So I know Austin left his contact info. If people leave their business cards or contact info, you'll send that email out.
Yes, I will send everybody those videos, and I kind of step through everything because I want everybody to understand how this works.
Also, you have a book out. You just released it, I think, in the last few months.
Yep, I've got an ebook out over tax strategies. I've got another ebook that I'm writing. It's taking a little longer, but it's called Profit Like a Bank, or Function Like a Bank, Profit Like a Bank. So I teach infinite banking, I teach velocity of money, positive arbitrage. Basically, I teach you how to make money the same way that banks and corporations make money.
In the book, I know it was the downloadable link wasn't working. We talked about that.
Yep.
But it will be up soon, right?
Yep.
Yep. So, awesome.